Welcome to Unfiltered Finance. And when we talk about trading, we usually talk about stocks or options, but there is a very unique thing, I guess I'll say, that you can trade. And it does not act like one normally would expect of a stock or, even an option. Nathan Tucci is with us today. And Nate, the VIX is one of the things that you love to trade. So we are glad to have you on the show. For folks briefly who may not even know what the VIX is, like what's a one-line explainer of what it is and how it operates?
So the VIX is a volatility index for options within the stock market. A lot of people will call it the fear index. In reality, it can act as that, but it's truly measuring volatility in terms of the price of forward-looking options.
So it's basically data points that reflect human emotion within the stock market.
Yeah, and more directly, and what a lot of people don't realize, what it's really measuring as a conduit for that is how the market makers are pricing the SPX options. So it's like, yes, it's a gauge of emotion, but it's an indirect gauge of emotion based on how market makers are pricing options, knowing that volatility is high.
So it's like a layer upon a layer. What
It
is the
is.
relationship between the VIX and the S&P?
So it is directly related to the price of those options. And so basically, what the market makers do is they price SPX options, which is a version of the SPY, or XSP or SPY, and they are going to price it not based on whether they think it's going to go up or down, but how much range they need to be protected from the market going up or going down. It's like if you think about Vegas in a big fight, they have to switch the odds around to kind of protect their money if the wrong event is to occur. And market makers do the exact same thing. When the market's really, really quiet, they don't have to price in a huge range for the SPY because it's not going to get blown out on a regular basis. Maybe one out of every 20 days, they'll take a hit, but most of the time they're cleaning up all of that free money from those options expiring worthless inside the expected move. But when things get a little crazy, that range starts to go up. For example, since the Iranian conflict, the S&P has been moving over 1% per day on average, which is extremely high in relative terms. Going back to, when Trump did the tariffs things, it was moving 2% a day. So, of course, they then have to price the options in expectation for those kind of big moves.
So it really, when you talk about volatility, it's directly correlated in most cases with whenever you see crazy headlines or crazy things happening in the world, it spikes and then it eventually recovers. So how does somebody, number one, how does somebody trade it? And why do you like it so much? And then we'll get to, kind of how you harness that
Yeah.
volatility
So,
for profit.
well, one of the things that people don't often understand about the VIX, the volatility index, is that one liner doesn't give you a real definition for the VIX because volatility should be totally neutral. It should just be how fast is the market moving. But in reality, it's incredibly sensitive to selling pressure. So when the market goes up a lot, VIX actually won't go up, which is one of the odd things about the market because you would think, well, hey, if it goes 2% up in terms of movement and planning, that should be the same as it going 2% down. But in reality, the VIX has a totally opposite reaction to those two scenarios. And it has to do with market makers having downside risk versus upside risk and a completely different formula. But what people don't realize is, hey, the market could actually move very fast. But if it's moving very fast in the bullish direction, VIX is actually going to go down, not up. It's only when the market is moving fast with selling pressure mixed in that you're going to see the VIX spike. But the beautiful thing about the VIX is that because of that relationship, you have two things going for you. Number one, the market is bullish more often than it's bearish. So VIX is going down more often than it's going up. And number two, even when things get a little crazy, the VIX has to kind of settle into its new normal at some point. It's not going to stay high forever, and it never has stayed high forever because it just kind of adjusts to that level of volatility. And then people on the human side adjust to that level of volatility. And as soon as that starts happening, VIX comes down even if the market hasn't, fully recovered. So a lot of people will say that the VIX is directly correlated to the SPY. It's directly correlated, but it's not consistently correlated. So there's a little bit of nuance in between there, and that's actually where we get our trading opportunity.
And so how do you even trade it?
So let me show you real quick kind of what the VIX looks like. For those people who have never seen it on a chart, this is what the VIX will look like. And this is over the last couple years. And so clearly you can tell if anyone tells you that it's just the opposite of the SPY, no, it's not, because the SPY is going to look like a trend that certainly has some peaks and valleys over the years, but is actually going from left to right, lower to higher. The VIX never looks like that. It always looks like this, where it has short-term periods of spiking and then it comes back down. And so for the VIX, the comfort level in healthy markets is usually below 20, certainly below 22. We've seen the VIX all the way down in the 12s and 13s, which is very, very low on a relative basis.
What
And
is
so
that
for
spike right there? Is that
this is tariffs right here from April of last year, where the VIX was over 60. That happens a couple times a decade, for example, on the VIX. But for me, this is actually one of the only assets I ever trade in a reversal, meaning it's one of the only ones I'll ever say, hey, it's going up, so I want to sell it. Usually I want to trade with momentum. But the reason that the VIX is unique is because of what we just talked about. It has a tendency to go back down. It's one of the only assets where I would trust that when it's overextended, I should actually be shorting it. It's funny because I would actually point to this as a major flaw with retail traders under any other circumstance. They say, oh, NVIDIA's overextended, we should short that. And I would say, no, it's overextended, but there's nothing that fundamentally says that it won't keep going up. It's just kind of like a cliche thing that looks ridiculous on a chart, but in reality, it looked like that in 2013 and then 2014, and it just kept going up. And then the other thing that people forget is that, okay, a chart's overextended, so I'm going to short it. Well, it can just go sideways after that to slow down. And if that happens, you're not making any money. You're actually losing money in most cases when you decide to short a stock that ends up just going sideways. All of that to say, the VIX is actually forced back down. Even when things normalize, even if the SPY doesn't go back up, the VIX is going to go back down. And I have a very crude drawing to represent that looks something like this. And the idea is, okay, when the SPY first starts to tumble, the VIX is going to go up in response. It's going to be directly correlated. But over time, even if the SPY stays down here and never recovers back to those new highs, VIX will come back down just because it's kind of getting, used to that new level. It's just kind of rolling out a new standard deviation without the SPY making a new high. So this is the part that makes it so attractive to trade, is that typically, generally speaking, as long as you give it enough time, it will come back down.
it's like gravity, it inevitably will return
Yeah,
back down at some point. So then how does somebody know when to buy, when to sell?
great question. So the way I do it is in 3 stages. So when the VIX is above 20, I would typically take a short position. Now, people who follow me probably know I do that as a debit spread because I just love trading that way. It keeps your risk small. You know your ROI potential going in. You don't have to mess around with whether volatility is changing and so on and so forth. So for me, I'll trade a short debit spread with the expectation that it will come back below 20 in the next 2 to 3 weeks. You could also just buy a put or another version of shorting, but for me, it's a debit spread. If the VIX then closes above 25, I'll add my next short position and I'll give it a little more time. So my first position is probably losing right now because VIX kept going up, but now I'm going to add another position with an even higher ROI and give it a little more time to come down. And then if VIX closes above 30, I'll add a third position. Likely my first 2 positions are losing, but my third position will have enough ROI potential that if VIX comes down, I'll be net ahead across the board. So the idea is take however much you want to risk, say you want to risk $3,000 and do that across 3 trades. Trade 1, trade 2, trade 3. And the rule is really simple. Just make sure that if any trade wins, you're net profitable. Because if you lose trade 1 and win trade 2, but you lost money, well, then stepping into the trade didn't make any sense. Same thing if trade 3 wins, but trade 1 and 2 lose and you're down money, well, then your trade didn't make any sense. So the way I do, people would call this like a modified martingale strategy, where you're changing your risk and your ROI to create a net advantage as long as you just win one of the trades. And if you look at the chart of the VIX, you can kind of see immediately why this is so advantageous, because even when VIX is going up, like somewhere over here, trade one might get in trouble, trade two might get in trouble. But by the time you're adding a trade three and you're fast forwarding to giving it 5, 6, 7 weeks, there's quite literally only a handful of times in 50 years that it would not have come back down and given you a winner as you gave it enough time to come back.
When you say time, what are you talking about? I mean, are we talking like a couple of weeks? Is this a day type compartment?
Okay, good question. So usually my first position, 2 to 3 weeks, just depending on what day it is and where your next expiration is going to be. When I add my second trade, so VIX is still going up, I'm going to extend that 4 to 5 weeks. And then if VIX keeps going up, I'm going to extend that 6 to 8 weeks on the third position. So as VIX gets more elevated, I'm giving it more and more time. And the general numbers here are, you'll win that first trade like 60+% of the time. It'll go above 20, it'll come right back down, and trade 2 and 3 are not ever going to matter. Another smaller percentage of the time, you'll get into trade 2. And then only about 10% of the time will you even ever get into that trade 3, because the VIX usually doesn't ever close above 30. In fact, you can see the vast majority of these, the VIX never did close above 30. So your kind of medium term trade would have gotten the job done.
So then when you're looking at when you're deciding to get in, is that I mean, how do you make those decisions? Is that going to be something that's headline driven, or you just are purely looking at the chart?
Just literally the chart itself. So above 20 is a first entry, a close above 25, or I should say set to close above 25. So we're going to take this trade like at 3:45 p.m. So it's not closed, but it's set to close above 25, and then set to close above 30. Now, again, if you're doing this just like buying a put, it can be a little bit trickier to manage, because you don't know what your ROI potential is on that trade. It just depends on how far it's going to move and what the volatility remains at. The way that I like to do it is with a spread, because then I can literally set up the trade knowing in advance that if that trade wins, I'm guaranteed enough ROI to make the whole position profitable. So again, for a lot of people, they don't even know how that all works, but it's basically saying, hey, if I trade $1 spread and I pay 30 cents for it, I know going in that if VIX closes below a certain level, I'm going to make 200% ROI on that trade. And when you buy a put, you just don't know. You have to kind of wait and see.
So then is this something you can buy just like you would buy a stock?
Great question. Okay, so you can't actually buy VIX or sell the underlying, but you can trade options directly on VIX. Now, they're weird options because they expire on Wednesday mornings. I don't know why. Actually, I think it has something to do with the futures market and when they get reset. But they expire on Wednesday mornings, which is just weird, because sometimes you're like holding a position, you forget that it expires the next morning because it's just not normal. So you do have to remember when your options are expiring and that it's going to be a weird date if you're trading VIX. Now, the way that a lot of people will, try to get around that, like, and trade it like a more normal asset, is to trade all of the proxies for VIX, because now there's a whole bunch. There's VXX and UVXY and SVXY and several others. And what they're all trying to do is represent VIX, but in a real asset, something that you could buy the underlying, something you could sell covered calls on, all that kind of stuff. My recommendation would be never touch any of them with a 10-foot pole. They are the worst assets on the planet Earth, and I hate all of them. So I would only ever personally trade the VIX directly.
Okay. And then here, pop that out so we can go back to full, if you don't mind.
Yep.
Because so my next question then, because it is so different from, let's just call it normal trading, is there a particular group of people who should stay far away from this, and those who would be more prone or more likely and should?
Yeah, well, I would say that is you do have to understand options to trade VIX, because number one, you can only trade options on it. So obviously you have to understand options. But number two, you really do, if you want to kind of trade this reversal mentality, you have to be aware enough to set up good risk rewards. In other words, if you are saying, hey, Nate said we should short the VIX when it goes up, and you chase the VIX at the wrong time and you get a 2008 or even, a tariff thing where your timing's not good enough, Now you're going to be shorting VIX at 20 or 22 when VIX can go to 70. And at that point in time, if you're chasing too fast and loose and you're, hey, Nathan said it's always going to come back down, you can get underwater on VIX very, very quickly because of how extreme it can move. So you do have to make sure you understand the timing aspect, you understand the ROI aspect. You're not just open ending risk because, hey, you think it's going to come back down. And the real risk there, Emily, is that if you say, hey, I'm just going to keep shorting VIX because Nate said it's coming back down, well, that's true, except that sometimes because things are elevated, it can go up to 65 and then it'll come down to 31 for 3 months. And 31 is now a lower baseline, but you're still completely underwater from the trades that you took. And so, yes, it came back down, but you didn't make any money on the way back down because you got in too early, too aggressive, all of that sort of stuff. So really understanding the risk reward part is what you have to be careful with.
Well, it's interesting because, as I was kind of learning more about this, there are some people that will trade the VIX as a hedge, which seems ironic when it's literally volatility, right? So in your opinion, is this speculation or is this something people could use as a hedge?
I mean, you're exactly right. People use it as a hedge. Some people like to do it where they'll like roll a position once it gets down. So they'll say like, okay, when VIX is below 15, that's unsustainable. We need more volatility in the market than below 15. The market's probably at all-time highs in this case, and I need a hedge. And so they'll, buy an option 6 weeks out. And then if it stays low, they'll kind of roll that option into a new 6 weeks out. And the idea is, hey, I'm probably going to lose money on this, like you would with most with most hedges. I'm going to lose money on this. But when VIX spikes, it's not going to go up 10%. It's going to go up 300% or 400% or 500%. And therefore, my option is going to pay out substantially when I need it. When the market drops and I need that hedge to pay out, it's going to be significant. There's a couple of things I don't love about that. I think it's an acceptable hedge. And if you have good, risk management and a strategy around it, and you always have the position open, because of course, that's the biggest problem with hedges is that someone says, hey, I need a hedge. And they roll it for 1 month and they lose money. They roll it for 2 months and they lose money. They roll it for 3 months and they lose money. And they say, man, all this hedge does is cost me money. And they stop doing it. And the next month, of course, is when the market drops and they needed the hedge, right? So that's the number. You have to be, very disciplined and mechanical about it. But the other challenge is the market also knows that VIX can go up 400% in a flash. So they're pricing that in ahead of time on that option, meaning that when you buy a call option and the VIX goes up 400%, you're not going to make 4,000% ROI on that option. You'll do great. You'll make 600% or 700% probably, but you're not going to make the multiple that you would on a traditional underlying asset going up 400% simply because the market understands how VIX behaves and the options are already priced accordingly. So for that reason, it's not my favorite hedge, but fundamentally speaking, there is a reality that once VIX gets below a certain number, I would call it 15, that you're almost always going to see some spike within the next couple of months.
So if people are not overly aggressive or getting in too early and they decide they want to do this, in your opinion, because the VIX has been busy. I mean, let's just look at like the last year, right? Between Liberation Day to the Iranian conflict, and who knows what else is in store for us over the next several years. Is now the time to do it?
Well, I personally think it's becoming a better and better environment to short the VIX, not go long on the VIX. The reason is because over the last decade, especially, our cycles of extreme volatility and fear have been getting shorter and shorter. COVID should have probably been a 2-year cycle of brutal, ugly, volatile markets. And I think it would have been 50 years ago. But because of the mechanics of the market itself, think about things like zero DTE options that flush money out of the market much more quickly. Whereas 50 years ago, you would have needed a 2-year bear market to flush the same amount of money out of the market as you can now in a week with zero DTE options that are taking money out. So from that standpoint, from how global the market is, meaning when the US stocks are weak, liquidity can come in from anywhere else in the world. The fact that technology is so international at this point that now Nvidia is not really a US stock, even though it's a US company. All of these reasons, in my opinion, make it a lot more efficient from a cyclical basis. And so what that means in practice is that when the VIX spikes, it's coming down more quickly now than it ever used to, even on tariffs, even on COVID, even on the Iranian conflict. I think it is rebounding to the downside in a quicker cycle than we've seen before. And I personally think that cycle will remain. It doesn't mean that we're not going to have a bear market whenever, this year, next year, the year after, where we'll have a true 12 months of the market moving down and VIX will be at an average of 35 for months at a time. That will probably happen. But I think in general, the flushes and the spikes will have a much quicker return to normalcy than we've seen in previous decades.
I mean, that makes sense. The speed at which information happens, that change can happen. I mean, it's like people are on to the next thing so much quicker now than they used to be that you might freak out, but then there's the next tweet or there's the next
Right.
development or the next Supreme Court decision. So when it comes to the way you trade, I mean, what percentage of, the work that you do, your portfolio is in the VIX versus everything else?
It's only in those scenarios where we get the spike that I even allocate anything. What I'll typically do, I'm not going to do it in my investment account. So I'm just going to do it in my active trading account with a fairly aggressive position. So I usually only have about 50K in my active account. I don't put all my money in there, and I risk aggressively. We can talk about that in a different video because I also think that risking 1 to 2% in your account is really bad advice for active traders, and I have a whole thing about that. But I only say that because when people say, yeah, I'll risk 10% of my account on a trade, they think, wow, this guy's an idiot. Well, no, it's because that's my active trading account purposefully to use
It's
that
like
money.
fun money.
Yeah, to use that money and use up the margin instead of just having it sit there for no reason. So just with that disclaimer out of the way, I'll risk 5 to 10% of my account on the active side for something like the VIX. And so far, we haven't had a net loser yet over the last 16 months or so since I started doing this more aggressively. Eventually, I'll take that loss, and the VIX will just run away and not come back quick enough. That will certainly happen at some point. But as long as we maintain something like 80% of the time, it's back down below 22 within a month, this is a really simple, profitable strategy. And all you have to do is keep your risk consistent so that the 80% is more valuable than the 20% and not do what a lot of people do is, hey, I love this strategy. I'm going to risk more and more and more every time because I keep winning. And the one time the VIX runs away, you just blew up all the other times that it worked and lost money.
Yeah. Yeah. Well, and I'm going to put a link in the description of the video below so that people can find you. But since we're here, this is something you trade on your show. What's your show and how do they watch it?
Yeah, so we do opening playbook every day at 10 a.m. I actually do an additional closing playbook at 3:30 p.m., which is much more active trading versus the more training session and opening playbook. But the VIX trade is one that we do commonly in there. So it's not a service. It doesn't cost any money. It's just, hey guys, VIX is above 20. Let's set up our trade. We'll do it live in opening playbook. I'll tell you exactly how much I'm risking, what my target is, all that kind of stuff, because it is just a situational trade that will pop up in real time. And then I'll trade it with my students in real time. So that's opening playbook, 10 a.m. every day. We cover all kinds of stuff. And if people are like, I don't know what this guy's talking about, spreads and fixed and ROI and everything else, come to opening playbook and you'll catch up. And I think you'll be glad you did.
Perfect. So this is just the introduction, and then
Yeah.
people, if they want to see it in action and how it works, they can go to your show.
If they want to yell at me for risking 10% of my account, they can go right into the chat and opening playbook and tell me what an idiot I am. It's all
You know
available.
what?
It's all
Keyboard
open.
warriors are a real thing.
Yeah, exactly.
Well, Nate, thank you so much. I appreciate it. And thank everybody at home for watching. We appreciate that as well. We would love to hear more from you about what it is you want to hear about on our channel. So add that in the comments and also hit like and subscribe.